So this will be our first Wook in review of the year. It's edition number 65. We have some fun topics today. Going to be talking a little bit about Mark Zuckerberg selling off some shares of Meta. Also talking about Robinhood leasing a new office in Seattle. And some more Wall Street optimism coming into this new year. So stay tuned. Disclaimer here. Says Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Do your own due diligence.
All right, good stuff, Joe. And welcome, folks, for our first Wook in review of 2024. For those joining live, I do have a screen share going on in the due diligence Discord server on the Stages channel. I'm not sharing my background right now. My office is in shambles still from the holidays, but I'll be sharing my desktop and reviewing some of the material that Joe has prepared for us in the newsletter that went out this morning. And yeah, we'll see. It may be a quick one this afternoon. We hosted our kind of 23 in review, 24 Outlook open mic on the at GMEDD handle on Wednesday night. So I'll do my best not to repeat things we talked about there. That recording's available on our YouTube channel. So Joe, yeah, let's just jump right in then to the Wook in review material, unless you'd like to add anything before we kick it off.
Nope. Just hope everyone can give us feedback on the year of broadcasting. Like we did a survey last year to wrap up the year, and we didn't send one out this year. But hopefully, if anyone has any feedback, we're welcome to receive it. We haven't yet finalized whether or not we'll be doing the book club or not this year. So if we get enough suggestions for books, we'll try to move forward with that. But over on the Discord, we have a channel for the book club. So send in any book suggestions. Right now, we've got 2 or 3 books being suggested. So hopefully we can get enough to do a whole year worth of books. But yeah, first story I have is something in the Wookie watch list. So we have Meta on the watch list, and it's news, according to a regulatory filing issued Tuesday, that Zuckerberg sold Meta shares worth more than $400 million in the last 2 months of 23. So it's the first time since November 21 that the world's 7th richest person trimmed his position in Facebook. So there's a chart here put out by Bloomberg. Zuckerberg restarts share sales as Meta rebounds. So Meta had a really big year. Is the second best performing S&P 500 stock last year, trailing only Nvidia, with shares now trading for about $344, which is just 10% below the record high hit in September 21. So Zuckerberg still owns about 13% of Meta, with his stake valued at just under $116 billion as of the closing bell on Wednesday, and that's calculated by Business Insider. So
Meta was just one of those incredible, probably the best example of how incredible these multiple compression and expansion cycles can be for some of these technology companies. I mean, on my screen, I'm trying to do a split screen just to kind of highlight, Meta traded all the way down to around 80, $90 in late 2022. And it had fallen from highs near where the stock trades now. It's not yet gotten back to those levels, but it had gotten toward 400 in late 21. So, I mean, the stock literally had a 75% drawdown, and then it proceeded to go up 400%, which is roughly what you need to offset your 75% drawdown. So just such a prime example of how, at least in short run, price can do anything, right? Did the business fundamentally get was the business fundamentally worth a quarter of what it was in 21, in late 22? I don't think so. I know I bought a little bit. I certainly didn't hold on to it for very long, uh, because such is the curse of value-oriented investing, I guess. But it doesn't even look so rich still. If we look at it now today, the forward PE on Meta right now is 20 and a half times earnings, which for the high, I'm going to use quotes here, for the high growth technology companies that everyone has to own, so to speak. It's not really that rich, I guess. I mean, it's not something I would pay. And I think it's expensive again, but it doesn't matter what I think. On a multiple basis, it still hasn't gotten back toward that high of a level. Like we're talking about 10 and a half times EV EBITDA for Meta, which it troughed out at about 5 times, which was incredible when it got down to $90. The huge surge in capex that was, in some's view, just being burnt on Reality Labs. They're still spending a lot on it. They just have had, as Zuck had said in 23, the year of what was it, year of austerity, whatever the damn term he used was. So, I mean, Meta's just crazy to have watched a stock of that size. It's 10% away from $1 trillion market cap, and for these stocks are literally have moved like penny stocks over the last couple of years. So it's been a tough time for people trying to follow the fundamentals, I guess. But yeah, Meta, Zuck selling. Last time he sold was near these highs. Who knows he still owns over an eighth of the company. I believe he still has control through the structure of the multi-class shares they have. So yeah, we'll see what happens. I don't know where my newsletter link just disappeared off to, so let me pull it back up. But I don't know, Joe, what do you think about Meta?
Just thinking about it, I mean, he owns an eighth of the company. He's still pretty much in full control of the company, the way the board's set up. Always got to wonder. So we talk about Tesla quite a bit. We talk about key man risk with Elon Musk. A lot of people invest in Tesla because of Elon Musk. Wonder the parallels with Meta. Do people see Zuckerberg as the face of the company in such a way that if he was to sell and depart, what happens? That's a curiosity. And
well, for one, if if $100 billion gets sold, I think the stock goes down. But
of course,
yeah, I agree with the sentiment that there's probably some key man risk. I mean, it's a founder. A lot of tech investors love to invest in founders, and I could definitely see this being another security like Tesla, not to the same extent as Tesla, but one that has key man risk that now that it's surged the way that it has, perhaps is that not priced in? Yeah, who knows?
Totally.
But quite a few dollars Mr. Zuckerberg still has, so he'll be all right.
He'll be okay. I don't think much can happen to change that. We can touch back on it after as well. But next story we covered in the newsletter was about Baba purchasing 9.5 billion worth of shares in 23. So Alibaba's on our Wookie watch list, and the company said on Tuesday that during the 12 months ending December 31st, 2023, so during the last calendar year, the company purchased nearly a billion shares, totaling about 9.5 billion US dollars. And this resulted in a net reduction of about 3% in the outstanding shares over the last year. So shares were down as of the time of me writing this, about 2% Tuesday's pre-market, but not sure how they're trading today. Haven't looked.
Yeah, closed down 2.5% or so today. It's at $73. I mean, we've talked a lot about Baba throughout last year, so I don't want to belabor too much of it, but broadly, China has some issues of its own. It has some big demographic headwinds with the low birth rates. It's got some kind of concerns over whether its consumers are going to step up and spend. It's just a very different culture, of course, than it is here. And Baba's facing, as its peer kind of JD.com, the incumbent sort of e-commerce players in China are facing it's core e-commerce business. It has other businesses, but the rise of Temu throughout last year and Shein prior to that, really eating into um, some of their share. Pinduoduo in China has been the shiny one that investors have opted for. I mean, when you just going back to the article, you noted significant uptick in share repurchases, which I know we had talked about early last year when there was the reporting, that Mr. Cohen, of course, had contacted or been in contact with Baba and had kind of recommended that same thing. Not that it was on the back of his recommendation, but they on a trailing 12-month basis have repurchased over $10 billion in stock. The market cap is at 183 billion USD today. So a lot of people say, well, you don't really have a claim on it, and I can appreciate the VIE arguments against long-term investing in China. We talked about it on Wednesday. My view right now, at least, is that it's probably the most of all the major emerging markets. It's clearly got the worst sentiment, and the valuations are really not demanding at all. So I tend to think that there's a trade to be had. I have some exposure to Baba, to JD through call options, which we'll see what happens. I mean, the relative valuations between Baba and U.S. tech, uh, it's extraordinarily wide, and a big chunk of it I think is justified. But I guess the question is this extreme level justified? I don't think so. Market doesn't care what I think. So we'll see what happens. I mean, I think JD is more attractive than Baba. Obviously, I think we have Baba on the watch list, so we've talked about it more. But these companies are at really undemanding valuations, and if they are in fact generating the cash that their financial statements say that they're generating, and in the case of Baba, repurchasing such a huge swathe of shares, eventually you run out of sellers, don't you? There was, I don't have the graphic on my screen, but there was a good graphic showing kind of the level of capital flows into China had really troughed out last year. And 22 was low, and then 23 was even lower. And it's like it can always go lower, but we'll see what happens. Tend to think China outperforms U.S. Large cap equities this year, but we'll see what happens. But can't argue with the math that they are repurchasing. At this point, it's gotten to be a low single-digit % of shares out that they did last year, and will they bump that up further? There's been some going back and forth over which aspects of the company will they be IPOing. There was some more writing over the last week or two talking about how poor the IPO market in Hong Kong has been. If anybody wants to talk more about that, feel free to come up. But otherwise, we can keep on rolling. We've got a couple more items, and then we can open the floor.
Yeah, final story in the watch list series is that we have Robinhood on our watch list, and they've leased a new Seattle area office. It's not really the most interesting news, but considering we do take a look at the company, I thought it was worth including. So Seattle's kind of looking like the next Silicon Valley to a lot of tech companies, with a lot of companies moving up there, and this one is no different. So the company's now leased an office in the Bellevue Lincoln Square South Tower. So Bellevue is right near Seattle, not quite as expensive, but also a very up-and-coming area. When I spent a lot of time in Seattle in 2019, it's definitely a booming real estate market. So the company is now leasing that 24,200 square foot space, and the company that reported the Robinhood lease has claimed that a growing number of tenants are shifting towards smaller office spaces, indicating a change in leasing preferences, which makes sense. So that's about it for that story. Nothing too interesting, but Rod, sure, feel free to add some thoughts, and then I'll let you also cover the highlights as well.
Okay, yeah, I mean, Robinhood, back over $10 billion market cap. I know, Joe, you use their application. I think a lot of people still tend to, those who are actively trading on their mobile devices, like the feel of the application. I have the app. It's like I don't know, it's like it's way down there on level of like importance to me, but it is better. It's superior UI UX than the incumbents, but that doesn't mean everything. Even though tech bros seem to think it's all that matters, I guess. It's trading at 31 times forward PE, but like, what is the business of Robinhood? And it's it's largely been a place to attract capital that is then gambled away. Its customers are transacting in a lot of higher risk uh, instruments. They Robinhood are making more money off of the degenerates trading options through the platform than they are on those who come in and are just buying and holding. So it's kind of it's a little bit of, I don't want to call it a catch-22, but it's like Robinhood is trying to assert, and it's trying to attract new capital. It's got some pretty attractive offers, actually, if you wanted to take advantage of transferring, say, your IRA or the like there. I know they're giving you a 1% match with no cap. So if you transfer a $1 million IRA, Robinhood gives you 10 grand. Granted, you got to keep it there. And of course, they want you to then, be on the app all day trading options and crypto, et cetera. So it's tough because you think about these financial institutions that are supposedly oriented around your long-term financial well-being, and if you actually understand the business model of Robinhood, the business doesn't work like that. Like they can't make a lot of money if you're not transacting and acting like a degenerate. So we'll see if you've got an uptick in maybe speculative behavior that happened in the back half of last year. Does that continue this year? I just think if I wanted to touch stuff that's oriented around volatility and trading, there's stuff that I prefer over that. Joe, I like Virtu, the market maker, and they have their own regulatory risks, but prefer them to Robinhood. I mean, going just to comment on commercial real estate real quick, Joe. I saw data, and this is not office space like what Robinhood's leasing, but just to go on to tangentially the warehousing space. There was a few stories this week in the Journal highlighting how vacancy rates have risen meaningfully. You had this huge decline to all-time low vacancies, during 21 and 22, when everyone and their uncle needed a warehouse to accommodate their growing e-commerce businesses. And that's reversed itself over the course of 23. So the vacancy rate's risen. It's now higher than it was pre-COVID, albeit still depressed versus the 15-year average. I think that was Cushman Wakefield data. It was, we're at 5.2 on the kind of warehousing side. There's a lot of new builds still coming onto the market, a lot of speculative builds where they don't have a client lined up. But that 5.2 reflects positively versus, I think it's 6.2 is the 15-year average. So I would expect that vacancy rate keeps rising, but it's not a red flag per se. It's just, there's still a lot of areas of commercial real estate that are, and we talked about, I think, strip malls a week or two, because it was a couple weeks ago at this point, still being near all-time low vacancies, having had a lot of strong performance still, the strip mall business in the United States. So, commercial real estate is a very broad space. And then when you think about going regionally, right, you mentioned Seattle doing better, than say, San Francisco or LA CRE. So it's a complicated space, but I guess see what happens.
Totally. So this next story is one that you suggested you include in the newsletter, so I'll let you take over. But certainly a good look into Wall Street optimism.
See if the link wants to load. Yeah, it was a Wall Street Journal story from the first of the year. Charlie Grant was the writer, and the headline is "Optimism Abounds on Wall Street This New Year." It's kind of the inverse of last year, broadly. And as we talked about on Wednesday, market forecasters and prognosticators were neutral to bearish heading into 23. The year, of course, played out quite differently than that, at least the major index levels. And now we've got the latest sentiment surveys have, after this week's slight declines in the indices, as of course price drives sentiment like no other. But sentiment had gotten back to 21 highs in some of the survey data. Some pretty extreme levels of sentiment to round out the year. They've come off a little bit in like this past week on some of the survey data I've seen, but still we have a very high level of optimism predicated on a significant number of rate cuts from the Federal Reserve, which what really matters is not what the Fed does. What really matters is, will corporate earnings continue to grow? Will the consumer continue to be able to spend? That stuff matters more. I think people obsess too much over, is the Fed going to raise or cut this month or that month? And even if one knew that precisely, I still don't know how informative that would be. The Fed doesn't know it precisely. Just to comment on that matter, we're at a 1 in 3 chance today, as of right now, per Fed funds futures, that there will not be a rate cut by March. We've got the meeting at the end of the month, so we'll talk about maybe some of the data that came in today in a minute here, but that 1 in 3 chance that there's no cut through the March meeting, so 2 meetings worth of standing pat. There's about a 2/3 chance that there is one cut by the second meeting of the year, and that it would happen at that March meeting. And then there's about a 1 in 20 chance currently priced, which is down from a week ago and a month ago, that there's 50 bips of cuts by the March meeting, or including the March meeting. So that's where the probabilities currently sit. Again, how much does it really matter? I mean, is a 25 to 550 Fed funds rate corridor highly restrictive? I don't think it's highly restrictive. Is it restrictive, especially for businesses that borrow based on shorter term rates rather than long term? Yes. Is it, is cutting short term rates by 125 bips or whatever is currently priced, bringing it back? It would still be a little tight, right? If you had a short term Fed funds rate at call it 400 basis points, that if you believe that their long-term view on 250, as the kind of neutral rate, would apply that there would then be, of course, further cuts into next year. But are they going to cut that significantly if we continue to see so much economic resiliency? And I think that's maybe the question. I think people I don't know. I tend to think right now markets are very hyper optimistic, as that story kind of lays out. And you've got all of kind of the prognosticators who were very bearish last year now are pretty bullish this year. So maybe we should just inverse the prognosticators, and therefore, for example, a survey conducted in December by BofA Securities found that fund managers were more optimistic than in any month since January 2022, coincides with the last all-time high. The group is collectively the most bullish on stocks since Feb 2022. Again, that was a December survey, so I'm sure if you ask people again in January, it's a little less so. But it's just a math problem. Multiples cannot expand unto infinity, and much of the returns of the companies, as we talked about with Meta, it was just the multiple re-rating massively, as most of its peers were. Did earnings hold up better than expected? Absolutely. Are earnings expected to grow at a pretty historically high level? Yeah.
I don't know.
Chris, hi. You don't know what? But anywho, Andrew, you came up. Do you want to chime in, sir?
Oh, hey, what's up, Rod? Happy New Year. And I'm agreeing with that Asian sentiment. I've been nibbling a little bit, just started to, but I'm also looking at some individual names outside of EM or XFI, with CPNG and SE are two names that are piquing my interest a little bit. Haven't done anything much yet, but I do think there's some value to be had there. I did put some money in Latin America a few weeks ago. I've done quite well with that allocation. Yeah, I mean, everybody still loves Amazon. I keep seeing Amazon come up as their top pick for the year. I mean, who doesn't? Every business of theirs is growing, I suppose. But yeah, law of large numbers does kick in at some point. And we saw some Apple antitrust issues this afternoon. Was hurting that stock a little bit. But for Robinhood, I don't know. I just find it's the Mickey Mouse of all brokers. I mean, I don't use any of these cheap brokers like Webull or Robinhood, but I think they give you alerts. Like I read, they give you alerts like "Hooray" when you buy or sell stock. I mean, that's just I think it's like trading for the mentally challenged. But maybe $5 or $10, it's worth a buy. I mean, I know somebody, an analyst, that thinks they're going to be the next Schwab. I don't understand that thinking. I mean, I guess they're 10 billion in size. But yeah, if you want to buy somebody serious, you buy like an Interactive Brokers. It's 4 times their size. But yeah.
Oh, good stuff. Appreciate it, Andrew. Chris, you're what's going on with your mic, but you're back up here. Do you want to chime in?
Hey, how's it going?
Hey, Happy New Year.
Happy New Year. Is this the first one since the new year?
Well, it's the first Friday of the new year, so
Yeah, so it's great to be back. New Year's greetings to y'all. But yeah, I remember you mentioned the HK IPO market, being pretty soft. Hello?
right.
Oh, yeah. And I think today, or just last night, a company called Shenzhen RoboSense. They're one of the big lidar producers, manufacturers, and they just went public. The market value, I think they IPO'd at was around $2 billion, 2 to 3 billion. But yeah, it's just really interesting, right? Because I think we discussed this before, but with Alibaba, like planned to spin off a bunch of their units, but like they've pulled back, on a lot of those plans because the market's been so weak. But yeah, I think Chinese equities, they're definitely look really cheap here. A lot of people either they're very afraid to invest in them, or they just can't invest in them, right? And if you're like a PM, you can't buy them. A lot of firms, right? Because it's Chinese, and because of the geopolitical risks, and yeah. So I think I've been just looking around to see, especially some of these industries that they were doing very, very well during the highs of 2021, as people were very optimistic, right? These are very transformative technologies, but then they just got sold off, into oblivion. And now, there's just yeah, I think that there might be some opportunity there.
Yeah, like was kind of mentioned before, if there's a reversal of the outflows, it's math, then prices will rise if that confidence returns. But what will be the event in China that triggers, I guess, that change in sentiment from ex-China investors? Right, the ex-China investors, the U.S. oriented investors, have loved other parts of EM like India, at the expense perhaps of China. But yeah, we'll see what plays out. I mean, I'm it's just tough, I think, as somebody who's not a native and who doesn't have contacts on shore there to invest in some of maybe the names, or at least to trade in some of the names that are maybe off the beaten path. So, and I'm sure there are superior instruments to the big names that we've of course brought up, but I guess that's to the advantage of folks who can maybe dig a little deeper, who have that line of sight or visibility into China, which we certainly don't. I don't.
Yeah, I guess it happened like towards the end of December, but there was that thing with NetEase, and the video game publishers, right? There was like
Right.
that the draft legislation that was announced, and then the market just hated it, right? Like it sold off like crazy. Some of these, internet gaming stocks went down 10, 20% in like a day. And like now you're seeing I see on Twitter, like there's some announcements from the board, like the governors in China, like, oh, like, we now, like, want to have more communication with like companies before we announce legislation, and have more dialogue. And like, I think a lot of that trust is lost, like a lot of people, are like, oh, it's like too little too late. um so I think that's a big fear, right? That, regulation. So like you'd want to see a lot
And
more
then
effort on
that
their part.
reporting this week that the official who was atop that agency was had left at the behest of, I guess, the CCP in some capacity. But I mean, clearly the state is cognizant of the actions it takes and the impact on its financial markets, but it's thus far not been able to shift sentiment positively, and the kind of whipsawing, I guess, of coming out with these regulation changes and then kind of reverting course, doesn't instill confidence, I would think.
And
yeah, I think that everybody's done so well, since November with the U.S. domestic market, that you really don't need to stretch yet, and unless there's some more negative, weeks. I mean, we just got a little selling from the beginning of the year just because everything was jammed so much at the year end. But even bonds, even a lot of the traders trading TLT did very well, and I see some reaching for yield go out there. I think, Rod, I think you're with British Tobacco. I think you should get a yield correction there. You saw with Verizon. Verizon was trading over 40, and I think at the lows it was 8 or 9% yield, around low 30s. So you're seeing some reaching for yield. One of my buddies said he bought Truist today, and I was like, "Why'd you buy that? You could have bought that 10 points ago." And he said, it's 5.5%. So yeah, I'm seeing more and more of that. I don't know if you're seeing the same.
There's definitely been a strong outperformance from large cap value to start the year, and I've seen that in some of the stuff that was beaten down, like looking at healthcare, CVS, which I know, Andrew, we've talked about. It's done quite well through both the fourth quarter after their investor day, kind of reset things a bit, and it's done well year to date. Yeah, I think it makes sense that some of these companies that have just grossly underperformed, well, now people kind of need to either rebalance themselves, or you can't just go to the same well because of what you said about the rule of large numbers. If you can't go up 50% every year when you're a multi-trillion-dollar company. The math doesn't really work that way. So, so far though, seems like it's been more of a large cap value and maybe mid cap value rather than the small. I mean, year to date is only a week, but less than a full week. But IWM has performed the worst of the big three indices, with the Qs not far behind, and then SPY, half the underperformance of NASDAQ. So you got the winners, maybe people realizing gains. We talked about this Wednesday, right? People wanting to realize the taxable gain in tax year 24 rather than 23. I'm sure some of that has happened this week. Some of the stuff that people sold off, then wanting to pick it back up. I know there's he left, but he made mention of it on Wednesday. Logical thesis, the notion that the S&P 600, the small caps, are very undemanding in valuation. Let me pull up Yardney's some of Yardney's graphics to put it on the screen. It's just not that demanding. But then on the other hand, the question is about the E. I think for U.S. stocks broadly, especially when you look at S&P. When we look at the net profit margin for S&P 500 companies, before the great financial crisis, it peaked at 10.5%. It got back to that by the mid 2010s, 2015, it got back to that 10.5. After Tax Cuts and Jobs Act, right, we got a big surge. We got up to 12.25 in 2018. That declined. Profit margins then grew past 13, grew almost to 13.5 in 22. So while margins have come down somewhat since then, and we're still talking about a market that expects forward profit margins to be 200 bips higher than they were in the pre-GFC. So companies have gotten more efficient, digitization, the forced embrace of digitization in many businesses' cases. So like, are companies going to remain this profitable structurally? Will those profits revert back towards the mean? I can't really comprehend the notion that profit margins just continue to expand again into infinity. It doesn't really jive with me, but some good data about some productivity gains, right? We've got, of course, the headline this week of Microsoft adding the AI key to its keyboard. Whoa, big deal. Apparently that's going to be worth hundreds of billions of value. But yeah, I mean, can companies keep growing margins to justify these multiples that they're trading at, keep growing profits? I don't know. I was proven completely wrong last year. I thought margins had a ways to come in, and they're getting marked back up again on a forward basis. So will people be expecting 13%? Again, this is for the S&P 500. Margins are going to be a little less for mid and small cap companies versus that, but that's what it comes down to: is can earnings continue to grow? Is it going to be driven by margin? I don't know how much they can keep taking on rev, and then I don't know. I find the multiples. Look, it's like for Wednesday we talked about can we go from being overvalued back to a bubble? Of course, and that could happen. Some people are betting on that happening this year. That we get that this is 1998, and we've got or rather maybe 24 is 1999. So we're going to have a wonderful another 50% year, driven by the hopes and dreams of AI and productivity, and whatever, what have you. Insert narrative here. So I mean, again, I try not to. I guess I don't really trade the index vehicles. You can at least monitor them and comment on them. But it's like I said on Wednesday, though, if you believe that is the case, that the real economy will prove even more resilient, continue to grow, and then you need to look at the stuff that's pretty beaten down still, the materials companies, the energy companies, who seemingly are not priced for a strong continuation of economic growth. And there's just a discontinuity there where you have some companies seemingly priced for endless growth and then others priced for a recession still, which we don't know what's going to happen, of course, but that's, I think, the opportunity is if you have expectations out of whack on one end or the other, have that variant view, and then hopefully things work out.
Yeah, I was glad to see the outperformance by CVS recently. Man, I mean, I thought it was in trading in the 60s, worth more dead than alive. You could even carve up the parts, but yeah, they got a new CFO. The Medicaid Advantage program is doing better than expected. I think they're over 10% there of enrollments domestically. So CVS still looks pretty good. I don't have as hefty of a position as I did, and I've been dabbling around with Walgreens a little bit just on the trading side, but yeah, that's performed well. And also Peabody finally got a bid this week, almost trading to 26 again. It's been a while since it's seen those levels, since Elliott's been doing their thing.
Yes, for me, just to be transparent, CVS is my personal account. I'm not talking about Wook, I'm talking about Rod, but I have about 3%, a little under 3%. I haven't covered any of those shares yet, nor have I sold any shares in the last few months. I mean, it's still, I think, inexpensive. I'm not adding right here, but I'm also not really looking to trim until maybe if we get closer to 90, then maybe I think about that. But yeah, you mentioned Walgreens boots with the divvy cut. I think somebody mentioned that earlier. I mean, between the two, I much prefer CVS, and we've talked about the insurance business, like you were alluding to, being hid. The value, I think, is hidden underneath all of the M&A that the Karen Lynch and team have undertaken to lean into this being the one-stop health services shop for consumers throughout their lives, which is going to take many years to see how well the Oak Hill and Signify integrations and growth all plays out. But again, it's not a demanding valuation that you're looking at. And I think people oftentimes, like we've talked about, get a little myopically focused on the retail aspect of CVS, which I think for most investors is the least interesting and attractive piece, the retail pharmacy. But they made some very significant changes to their pricing model, or announced some significant changes to the pricing model late last year. So yeah, it'd be interesting to see how it plays out. I know I'm not an expert on the life sciences space in general, but I know a lot of folks are pretty bullish on that kind of within healthcare as having some good room to grow. I mean, if you're a huge techno optimist, then you're probably expecting us to have AI cybernetics sometime in the next few years, and that's going to make us so much more productive, and it's not going to impact jobs either. It's going to be a perfect utopia. I don't believe it, but clearly a lot of people in the market do. I did, I guess, Joe, what do we have left? I don't feel like going through this economic stuff too much. I'm going to skip over that. I'll just mention, in my personal account, added a position back today. I had owned GoGo in the past, and GoGo is probably most consumers still think of it as the crappy Wi-Fi that they got on their commercial aviation flights over the last decade or two. That business was sold almost 3 years ago to Viasat. So it's a business aviation pure play, and it has been for a few years now, really since late 2020. So what is GoGo providing? They're providing the hardware onto business jets, smaller planes. We're not talking about 757 that Mr. Trump is flying around in. We're talking about much smaller aircraft that they are predominantly in North America. That market, people continue to want connectivity. So it's a nice kind of a business model where you have to make that upfront install on the plane, and then GoGo is going to get nice high margin services revenues for many years to come on that install. They've had some issues over the last couple of years with the 5G chip that they will be rolling out. The new timeline is third quarter of this year after multiple delays. So to me, the stock's pretty, sentiment's gotten pretty bad on the stock, compounded by things not going to plan for the rollout of the 5G network. I think there's a more maybe fear of stuff like Starlink priced in than the actual economic realities will show and bear out. I'm trying to think of the podcast, but if you just do a Google hashtag search on Twitter, you'll find my friend Brett at Chit Chat Money had posed the question about GoGo earlier today, and a few people had shared some resources on that thread. But that's an interesting one. It's not normally a space you guys know I don't really like tech a ton, but it is. I think it's interesting here. It's trade. The free cash flow guide they have for 25 has 175 million at the midpoint. The EV is about 10 times that today. The market caps, they have several hundred million in debt. So the market cap's 1.2, the EV is like 1.75. But that when you think about those cash flows, they're going to come in, once they get through this kind of investment cycle to make these 5G chip installs that begins hopefully this year. Once they're past the capex cycle, then they guide kind of a 40% EBITDA margin, adjusted EBITDA margin. So you're backing out some of the SBC, whatever, but 40% adjusted EBITDA margin that's trading right now at a NTM plus 10%, EV free cash flow yield. I mean that's not that demanding. The company's got done some buybacks that obviously are above the current level. In September, they had, and I think announced another buyback program. So like they're levered, and they're a levered small cap, right? So they've not really gotten the rally that some of the other levered small caps got in the back half of in the fourth quarter really of last year. And I don't know how much of it is just the concerns over maybe the competitive environment, the concerns about the chip deployment. But I opened like a 0.5%, 50-ish bit position today in GoGo. And I sold a little bit. I trimmed 1/8 of my Echo Patrol today, which has had a nice run here. And I'm still pretty overweight energy, but I'm trying to reduce that a little. But yeah, GoGo is one that I think is an interesting business. It's definitely one that when people hear the name, they think of what it is, what it used to be, rather than what it is today.
Yeah, Ron, I searched up your username here on Twitter to find some of your GoGo tweets date back multiple years, so you've been looking at this ticker for a while. The only thing I could think of is what you already mentioned was the Starlink concern, but I don't think that's going to be something that's going to take a major market share anytime soon. Granted, it could be a decade out before that.
The antenna that they have to install, it's just I'm not going to go into the technicals on it. I would say that what their core market is, I don't think it's as easily penetrated by Starlink as maybe what observers would think. And they've got some litigation with Smart Sky, which is a kind of a startup that's trying to break into the market. But remember, they're offering an air to ground kind of coverage, so it's chiefly always been a North American offering. They've expanded to have some partnership with some of the satellite companies to get that to be global. But when you think about these business jets, they're not typically, a lot of them are just staying in North America. They're not doing a lot of international airfare, but at least opens up the ex-North America market, which is I think only like North America is the core of the business aviation market, but the ex-North America market does give them an incremental growth runway. But yep, it'll be one to see how it plays out. Hopefully that chip, they don't have any more issues with it. Sick, I think I saw your hand up. You want to chime in?
Well, it's less about the like the Starlink thing and more about your EC positions. I caught like the replay of Wednesday's Wook and Review, and I know you guys were talking about like more on the EC and the PBR, the emerging markets oil energy sector. Can I ask why you reduced the EC? Is it just because you're overweight, just to reduce risk, or?
Yeah, it had grown to be closer to 4.5-5% position, and now it's closer to 4. So it's still a pretty large. It's a top 5-10 position.
Okay, like are you just like holding cash for, instead, or are you shifting into something else, like what you said, like maybe something more like CVS, strengthening other positions?
I used the part of the shares that I sold today to fund the GoGo buy today, as well as cash I had on hand, which I still have a very large cash position. It's still in, I think, the mid-20s, give or take, percent. Potential, yeah. So, I mean, I'm actually wanting to reduce my my net long further, because I don't think, again, that generally speaking, I think people have just gotten so overly hyped and forgot. We just so quickly go back to the old mindset of, hey, rates going down, stonks going up, it's going to be a great year. And, look, 23, of course, proved me very wrong. But I just don't believe we're going to have another dot-com boogaloo. I'm still short a variety of discretionary names. And while they had ripped my face off in the fourth quarter, it was nice to see some of the air come out of the balloon on that. But yeah, I mean, for me, trimming Echo Patrol, it was within the context of my broader portfolio. I did not yet trim PBRA again. For me, that's like 320 basis point position. So I mean, between those two, we're talking a pretty big position, right? For my personal account. So I'm still pretty darn bullish on LATAM growth, as evidenced by that.
Yeah, like I've been holding on to like EWZ about 9 months ago, I think, is when I jumped into PBR. Like that took me about like good 6 months to jump into, but whatchamacallit, I kind of regret getting the EWZ exposure, like the general Brazil exposure, versus like just buying just general PBR right now. But um, but what I've been seeing and hearing, I mean, like I forgot which space it was, but they were talking about how energy usage right now is probably going to go up if there is no recession. Then we're going back and chugging along. And the other
And
thing
even when
is,
there is a recession, right, historically, energy usage is not going to decline, at least not materially. I mean,
yeah, and
2020
then,
was just such an aberration and an abnormal event. I think people are still, energy investors broadly have had a pretty shitty run the last decade, since the highs of, I guess, 2013 or so. So I think energy is still just an out of love space. There's a lot of people who, for whatever reason, are they cannot purchase a lot of energy companies. The green energy space, actually, a lot of them had gotten beaten down so much so that I think some of them might be getting interesting. But to me, broadly, that's just a capital graveyard. Like that's just a place for capital to get destroyed, given there's just going to be so much competition for all that. I think EVs, there's still a lot more failures to come in that space for the startups. But I did buy an EV over the last few weeks, so there's that.
congrats. Wait, it was the Ionic, right? Or what?
Yeah, I got
think you
the
might have mentioned.
Ionic 5, the Hyundai Ionic
Nice,
5.
nice. Yeah, like the first off, like whatchamacallit, like EVs and like green energy are so hated, like in the energy spaces here on Twitter. They were just saying, yeah, like it's the first sign of a failing energy company. Get out if someone's like I guess like starting to invest more into the EV sector, which I'm like, the amount of energy use that we need, it's just growing exponentially. But here's the other thing that I heard. I don't know if you can confirm this for me, but Brazil's domestic usage for like gasoline and oil are going up. Therefore, PBR is probably going to be like exporting less to the U.S., right? That's yeah. Like I'm trying to figure out like where the hell I heard it from, but they were the first to cut rates 6-7 months ago, I think, right? And then Brazil is just overall just what is Brazil? Well, Brazil just in general is just going up, or their markets anyway. But I don't know if you have any views or like visions on that side of the world.
I mean, not super informed views, no.
Got it. Well, right now, like I'm still holding on to my positions because actually, like I think I mentioned this like a couple of weeks ago. Well, was it before the holidays about Zim and shipping and like the Red Sea, or like the issues with like Yemen, and I don't know. Are you going to do any plays on that side of shipping, or are you still like staying out at the moment?
I've not touched any of those, like Zim or insert whichever one you want here. I'm inclined to think that the rate bump that we've seen, which has been like 20+% spot. I mean that's going to be short lived. It's not going to be a structural change. It's going to be a transitory price spike. Sure, there will be some boon to 1Q and who knows, income statements for those shippers, depending on how much exposure is spot versus contract. But longer term, it's never been a great industry to invest in because it's chronically people investing in more supply, bringing supply online, and it's not a very good industry. The competitive dynamics are great for consumers of the services and not necessarily for the companies. I mean, they've improved it somewhat, right, with the consolidation of the shipping alliances, but even so, I don't think this is ever going to be an industry where you are buying and holding these stocks for years and years. I mean, they're cyclical. Is there going to be a blip up in the cyclicality? Can you make a trade? Sure, and I hope everyone makes money on the trades. But for me, I would be more inclined to short these spikes rather than thinking that it's a change in the trajectory for these companies. But again, I'm not an expert in shipping. I just know enough a little bit.
Yeah, like I've been like looking at like just like what happened during like 2020 spike when shipping just literally shot up to the moon essentially, and then
yeah, what an absurd demand shock, once in a lifetime demand shock. I mean, there were only so many containers and so many ships that could haul them, right? And that I think
like,
again, to me, that's an example of where people see a one-time type event, and now they start to underwrite that as a more normal event, and I think that's a dangerous thing.
No, I completely agree with you. I mean, like when we looked at what happened with Zim, it like this plays probably just like a general small short-term trade like 6 months out is what I'm thinking before like the US says, all right, we're getting pissed off. We're going to actually do something a little bit like step up. And
Zim's already doubled, more than doubled, right, in 2 months. Yeah. So yeah, sure, it's off the 21 level. It's off of the levels it achieved in 22, those highs, but I don't think it ever gets back there.
Yeah, and I don't think it's ever going to be the levels that it was in 2020, mainly because it was such a like what you said, like a black swan event. Like when like Joe probably knows, like looking at like Long Beach Harbor being like back to back just blocked out, and then like I myself, drove out to like Santa Monica, and you could actually see some ships just like out in the distance. Now you can't any. It was like
I vividly remember this, Sick, because when I was at Ryder on the corporate strategy team, one of my jobs was like I created this kind of industry news broadcast where we would put together all the different news and happenings impacting the company and its competitors and the industry and the like. And yeah, I very vividly remember closely following all of the craziness in both late 2020 and through 21. I worked there through the end of 21. So, I know, Austin, you're in the audience and and we've talked about on the transport side that I think you still have this syndrome where investors saw wonderful returns, wonderful improvements in the operating results for these businesses in a very aberrational time and place, and are now underwriting a return to or a more continuation of outsized returns and profitability for these companies, and what are historically very highly competitive spaces where there are very low barriers to entry. There's very easy switching between suppliers if you're a consumer of the services. Like truckload carrier is not a place. Although, as I mentioned on Wednesday, the one that I had been watching closely that I had unfortunately not re-entered, Dasky, the flatbed carrier, got taken out at a nice premium. So woe on me for not having the position there. But broadly, again, it's a very competitive, just like shipping. Over the road transport is. Yes, LTLs have networks that make it a little bit more defensible, but the LTLs are just bloated. I'm short XPO. Common stock, and I think that the hype over how much better these businesses are because of Yellow not being around anymore is a little overblown. But I don't know, Austin, if you want to add anything to that.
No, I mean, that's well said. I'll probably just basically parrot what you just said. I mean, in theory, the whole yellow catalyst makes sense. But I think what really happened is basically it just made them see modest declines in revenue instead of being catastrophic, right? It doesn't make these things buys. It means it's a less bad situation than it otherwise would have been. Like XPO saw like less tonnage per day last month with their biggest competitor out of market. I think that speaks volumes about the state of the market. And generally, I think the disconnect that I see is everybody thinks that this rebound that we're going to see in the transport sector, whether we have it or not, is almost irrelevant for this, is going to look like 2021 looked like. And I would argue the rebound, if and when it occurs, is going to look more like 2019 because there was just so much stimmy fueled e-commerce demand that just really inflated all of these numbers that I think we're going to go back to the 2019 growth trend, and that I don't know, that looks at stuff like XPO probably down 30, 40, 50% wouldn't surprise me. ODFL, I don't know, down 25, 30%.
Wouldn't surprise me either. Good resource if you care about freight or transports. CAS Information Systems puts out a monthly report, which Tim Denoyer, who I had the pleasure of working with over many years when I was at Ryder, he writes up the report. I think he's a great analyst, and you can get that free monthly. That report comes out, but on my screen I have the CAS Freight Shipments Index, and you can see that at an absolute level, shipment volumes as of the latest report are roughly on par with year-end 19, which was 2019 was a freight recession, as 23 has been a freight recession. So the level of shipments has fallen way down, and the amounts paid for those shipments are still quite high. But the issue with it is that operating costs for participants in the industry have risen markedly. So you've got people chasing fewer shipments. Spot rates are way down, and like you said, Austin, the outlook is that at some point mid-year or so, freight starts to really inflect upwardly, perhaps spot rates. There's still a big gap though where spot rates are cheaper than contract rates, which was going to put a dampener on how much contract rates could possibly rise. I think contract rates, I haven't seen people's like 24 full year forecasts for contract rates, but they cannot be more than maybe flat at best, I would think. I don't know, Austin, if you'd add to that.
No, I agree. And on the LTL rate side, I don't know how much higher they can go until you just take a segment of the freight that's typically handled with LTL and just give it to the truckload market, right? Because XPO is hauling some percentage of stuff. It doesn't have to be LTL. It could be done with a truckload carrier, right? Just less efficiency. But if the spread between those rates gets too much higher, I don't know. I just think there's a cap on just how high LTL rates can go.
Sure, and one reality of the market that I know I've mentioned in the past on some of these discussions, and that I've seen kind of Craig Fuller and the Freight Waves team really highlight of late, is that it's just a different environment for these smaller. The vast majority of truckers in the country are just one man or woman shops. It's just one truck fleets, or very small fleets, and these folks had wonderful years in 21 and much of 22. Their balance sheets got a nice boost. And the difference today versus back then is that there's so much brokered freight that if they need to find a load to keep the wheels going and keep cash coming in the door, even if they're losing money on an operating basis, just to keep that cash flow coming in, they will take that freight. And there just really hasn't been the necessary purge of all the incremental capacity that entered the market in 2021. I worked very closely with Ryder's used vehicle team when I was there. It was an issue for Ryder for many years. That's a fun story for another time. But the people that were buying the used equipment in 2021 and early and late 2020, those were new entrants who had never been transportation companies before. They just saw this one-time situation, right? This massive demand spike. So you had a massive influx of new operators, new people who'd never done this before. And the consensus seems to be by the people who've been around the transportation block a while that rationalization of capacity has been slower than people had expected. And until you further rationalize the supply of trucks out there that are trying to haul freight, that muted level of freight that I just mentioned, with shipments being at 2019 levels, then you just have an out of balance market. Price is not going to rise until you resolve that.
Yeah, I mean, I agree with all that. And the other thing that I think a lot of people that haven't worked in the sector just don't really think about, not that it's complex or really that surprising, is that the pool of truck drivers or potential small business owners for trucking is not static, right? Like a lot of these people, like they don't drive their entire lives. When the market's right, they'll drive. When the market's better to work construction, they'll work construction. When the market's better to do manufacturing or something else, they'll do that, right? There's people that just hop between trucking and other industries a couple times a decade, right? So like the pool of drivers can expand or contract pretty quickly just depending on the conditions.
For sure, it's not monolithic. Andrew, you want to chime in?
Oh yeah, I just wanted to chime in on Zim. I'm very fortunate that I avoided that one. I looked at them, I guess, when they were in the 60s, 30s, and then around in the teens. I didn't know it was going to go to $6, but I wish I had sold it if I did. But yeah, I mean, it's just you just got to realize that shipping sector and sorry about this, Austin, mining. Miners are just where the heavy short sellers are. Those are their bread and butter. Just because over a long duration of time, the businesses usually don't pan out. So you really got to know you have something special, which is very, very rare, as we know.
Good stuff, guys. If we want to keep talking freight, feel free. If anyone wants to change the topic, feel free. It's 5:11. We got through all our prepared material. We'll probably keep this going till at least 5:30. Otherwise, we'll wrap at 6. But yeah, I mean, again, on my screen, just the Department of Transportation operating authorities, the net additions and net subtractions of those operating authorities. And while there are multiple thousands of operating authorities that are getting revoked, it's just not enough on net still to offset the insane influx that was seen in 2020 and 2021. So I think there's several more months of rationalization to be seen. The stuff that I would want to look for to get a sense of if we're starting to get to that inflection of supply having come in enough for relative to where demand is, that price could start to rise. You would want to see outbound tender rejection rates begin to rise, meaning because you basically would expect that people will go shop around more because rates, the rates that they're able to offer under contract, and yeah. Anywho, I need a coffee.
Yeah, I don't know if you guys follow the kind of steel business closely or not. I don't, but one that I have a small position in that I'm interested in. I believe they report on Monday. If it's not Monday or Tuesday, commercial metals company. I really like that one, so that'll be one good earnings report to kind of watch. I could see it going either way from here, but long term, I really like that one. I mean, they have large refining operations in both the U.S. and Poland. I think they have an ability to kind of like scale up their copper refining business pretty significantly. And we're going to need a lot of copper, and nobody wants a copper mine in their backyard apparently. So it's got to come from somewhere. And I know it's kind of like cringe to say, but when this whole deal's over in Ukraine, somebody's got to rebuild that country. Like it will get rebuilt at some point, and somebody like Commercial Metals Company in Poland, they'll probably be one of the big benefactors from that. So it may be about time to start looking at companies like that because just the Ukraine infrastructure play, it just has to be massive at some point.
It's an interesting one, Austin. I'll have to look into CMC.
On when you think it's ending, which I don't really know how close it is to ending because it's not like they're in a rush to kind of rebuild everything that's been blown up at the moment.
Yeah, fair enough. I mean, I plan on holding that one for years, most likely. So could take some time to play out. But it's a good business otherwise. It's not dependent on that.
And the valuation certainly doesn't look demanding relative to where the company's been the last decade.
Yeah, but steel company is also a tough buy if you think there's going to be a recession too, though. So I mean, it's I wouldn't say it's a slam dunk.
Throwing it out there, has anybody done any work on tires? I know it's completely random, but I'm just starting to look into tires.
From when I was at Ryder, but I guess what questions do you have, Paul?
No, I mean, like, don't get me wrong, I know basically like zero about them, but who was it? I saw Carl Quintanilla's post this morning about the relationship to tires and EVs, because EVs have a heavier weight load, so they obviously get worn out a lot faster. I mean, granted, like EVs as a percent of total market share is quite small at the moment, but I don't know, just a little piqued my interest because it's an angle I haven't thought of before. Because everyone always gets fixated on batteries and range and whatever, but then you go to the tires.
The number I've seen, Paul, is about 20 to 25% uptick in tires consumed per on a like-for-like basis for EV versus ICE.
Over what time frame, though?
What do you mean? Just running an electric car with tires, you're going to consume your tires at a 20-25% faster clip than you would on an ICE vehicle.
Oh, you mean just in general? Got it. Okay, I thought you meant like 25% more tire spend in relation. Okay. No, I guess that makes sense. It's just.
I mean, all else equal, for the same number of miles traveled in an EV world, you're consuming materially more tires. The other piece of the tire story, the longer term, story, if you will, is that when vehicle miles traveled rise meaningfully through AV, that the tire companies, may be better positioned in that future as well. So I mean, that's definitely something I've followed for years now. The EV tailwind for tire consumption and the AV, which is still a magic, when and if. But the EV is real. I mean, that's the way they weigh more. Your scrub forces on the tire are real. It's an increased operating cost, even though a lot of the other operating costs, of course, go down.
Well, yeah, you're hoping. Yeah, they will, but I don't know. Ever since I got hit with that battery replacement cost, down the road, I was like, who the hell? Why would you buy this? But no, the tires thing is interesting. I don't know if I'll actually do anything with it because I think it's just too slow for me. But just the thought of it was just interesting.
It could be, to me, tires. The time for that, I would think, Paul, is after we get, I guess we don't have recessions anymore. But if there's a recession, on the back end of that, maybe if you can get the tire companies for a good price, maybe there's something to be had.
Yeah, buy the dip scenario, but sorry, I'm
and I know there's been consolidation, but it's still one of those or unfortunately, just like with EV, you just have these super cheap, exports out of China that have also. That's another competitive dynamic that's changed over the last decade or so.
Yeah, but even then, it's I had to replace a couple tires on my car earlier in the year, and they were $280 a pop. That doesn't even account for the labor involved. That was literally just the tire plus tax.
What kind of SUV or truck are you putting them on?
It's on a. It was on an Audi sedan.
Oh wow, $280. Okay, on a
tire. Yeah.
Sedan. Yikes.
Yeah. Didn't really think that one through, but whatever. Hindsight 2020. But then I know there's obviously always deals to get made. Like there's the whole discount tire business, and you have like Costco memberships where you can get some pretty good deals on tires if you're a member and stuff like that. Even though like I'm not, but I mean everything's going up and to the right for that entire industry. It's just like is it worth it in general? I don't know if anybody else has heard about it too, because I love chatting about it. But if anyone has any interest in GLP-1s, it's an interesting Bloomberg article that came out today about Medicaid and Medicare coverage in states and how it's basically bleeding states dry of their budgets. So there seems to be new criteria popping up on a state-by-state level about who can qualify and who can't qualify and for how much, because the states they just can't support spending that much money to help people lose weight, which I know is some people's thesis, because access to treatment offerings was quite the issue if insurance covers it. But now if states are pushing back, you kind of close off a large section of the population that kind of relied on that for anyone who follows.
That's Ozempic, right?
Well, it's like all of them, right? So you have Ozempic, you have Wegovy, then you have Lilly's Zaputo. I always mess up that name, Zaputo. But in general, right? Because if you did qualify for Medicare, Medicaid coverage, then the states would cover you, right? So if it's about $1,000 treatment, I believe with insurance you can get it as low as $25. But however, if the state is basically subsidizing that because of the coverage, it's just not sustainable for states to do that, right? They're just going to burn through their ability to pay for that. So that's kind of why they've increased the criteria necessary to qualify, or starting to increase the criteria to qualify.
I thought that Medicare could not pay for GLP-1s. Like it's only the employer coverages that are including these drugs right now.
No, yeah, I mean, I gotta pull it up because I was reading it today. Like Connecticut was pushing back. What was the other one? Vermont, I think. And sorry, I'm also like breathing heavily as I'm outside walking my dog. Oh, where'd it go? Oh, so the Eli Lilly one is Zepbound. That's how you pronounce it. But yeah, it just came out today. Oh wow! And also more research
I don't know if you
got published that users have less suicide risk. For what it's worth. Sorry.
Welcome up, Belligerent. You want to chime in?
Hey, are anyone able to hear me? Hey,
Yep.
Sorry, I just wanted to chime in because I think what the coverage, how the coverage works is I don't think the government will cover it when.
You broke up a bit. I am going to assume what you were saying is that the coverage would only for Medicare be when it's for diabetes as opposed to for the weight loss, right? Yeah, sorry. Can't really hear you. I guess.
Okay, so it's not Medicare, it's Medicaid.
Okay.
So it's not Medicare, it's Medicaid. But Yeah, like North Carolina says it's pushing back, Connecticut's pushing back, Virginia's pushing back. Delaware is warning of a surge in claims submitted, and they're recommending cost controls. Yeah, they're just basically saying like we just like the budgets are just getting out of control, and they just can't keep paying for it like this. Which I thought is interesting, right? Because I always treated it as like users taking it as a cash pay option. I've never actually really put heavy weight onto the whole insurance coverage portion, especially when you talk about like off-label use. But it was interesting to see like I guess states are just really seeing the brunt of it. For anybody who is bullish on the industry.
I appreciate the share, Paul. I guess I'll mention it since we haven't talked about it in forever, but we did, of course, publish a research report on PLBY Group in July, so we're coming up on 6 months ago. And somewhat interesting, that stock has 3 more trading days to go now to regain its compliance. It's traded at or above a buck for 7 trading days now. It had a pretty big surge there in December. And while there hasn't been any fundamental change as far as we know, we do know, as they disclosed in our latest earnings, that there's at least one interested party in at least the China business. I know that there have been, based on our conversations with those individuals and entities, multiple other interested parties. Unfortunately, though, it still remains the issue that Ben Cohn is the CEO and refuses to sell anything. So, well, that one will be interesting to watch play out this year. One of the many small craps, if you will, leveraged shitcos that have rallied meaningfully over the last couple of months. And as it regains compliance with its listing requirements for NASDAQ, we'll see if that decides to draw some more speculators in.
All I know is they are looking, from what I heard through the grapevine, that they are looking for like another multimedia producer or something. I don't know if they're trying to expand out of the media side, but so was like the general bounce back up just because of rate cuts, and it's a small cap for PLBY, and I mean fundamentals really haven't changed within like the last 6 months since you guys published it. Was it just general sell off also like 7 months ago, 7 8 months ago?
Multiple people I knew who owned materially sized positions exited in full in the fourth quarter as well as late third quarter last year to lock in the tax losses. So, stupid things happen with illiquid stocks, and this is certainly an illiquid one. The daily trading volumes, with the price kind of rising again, it's now back up over $500,000 trading on an average day, but had gotten down to a few $100,000. And again, I think the disconnect is largely because of the scumbags that have control and the view that they may have been hoping for a delisting so as to steal the business again, but it looks less likely now. There's 3 more trading days that it could sell off 14% or so and change that. But if they regain compliance, it's a little harder for them to try and use delisting as a means to expropriate shareholders. But I'm sure that Ben and Suhail will find a way.
Well, speaking of which, you guys got time to talk about like what happened with VTNR earlier, Vertex Energy?
Oh, what a delight.
Oh man. So essentially, like they're just getting like a $50 million loan, essentially, right? And then people are just like wondering, like, is it because like they're just trying to like hang on, or is it because like it's like a weird thing to like pull out a loan for at the moment, isn't it?
Yeah.
Or
So let me say I tend to find stock twits is almost always just noise, but rarely, occasionally, you find some actual due diligence shared. And in this case, there was some folks who'd reached out to investor relations, got a detailed response from them that was shared there. So I'm gonna try to pull that up and kind of regurgitate what the company had to say, at least from that communication. I mean, what essentially has been happening is that they've been pursuing strategic alternatives. This is a pretty broad, generic statement with working with Bank of America. And it's what does that look like? They have some legacy refining assets. They have the renewable diesel asset on the Mobile, Alabama conventional refinery. So, what kind of a deal are they going to do? Is it a 50-50 JV on RD? Is it something different? I don't know what it's going to look like. But in essence, what the company had to say was that they really needed more capital. They needed more liquidity so that as the deal gets toward consummation, that they don't find themselves in a position here. I have it on the screen now. So it was from John Ragazzino, or rather, I guess the IR at Vertex. I don't know. They talked about. Sorry, it's a multi-thread with a bunch of images. So IR's reply basically is that, quote, yesterday's price action reflects a broader misconception of the underlying fundamentals of the business implicit in the unattractive terms. Oh, no, that's sorry, that's not the IR response. The IR response is that Bank of America strongly cautioned management against shopping this to multiple banks. With a significant amount of interest seen in the potential JV partnership, there are a large number of companies which are currently in possession of MNPI under NDA to evaluate the RD renewable diesel asset. B of A strongly cautioned the team against going out to multiple new institutions and bringing them over the wall, as we call it, as it could quite possibly derail the entire JV process, which would be a disaster. Bargaining power considerations. Considering the above, and then keeping in mind that the alternative of simply hoping for the best and relying on the existing cash on hand of $80 million to make it through the completion of a JV transaction would potentially decimate our bargaining power with JV partners. It is no secret that refining margins over the next 6 months are going to be challenged. Potential partners are well aware of our liquidity situation. Nothing would destroy our ability to negotiate more than entering the final weeks of ironing out a transaction with a very urgent liquidity problem on our hands. This would lead to JV partners exploiting this fact and lowballing the hell out of us on a deal offer. And this is from Vertex IR, purportedly. They claim that it is a high cost on surface, but the lesser of two evils. So while paying 17% annually with additional warrants is incredibly expensive, we must consider the alternatives and the impact each would have on value creation. So then they kind of lay out, the option A was to shop a larger transaction with a new group of lenders. They talk about the incremental costs associated with that. They estimate at 15 million. And then they talk about pressing their luck and risking an emergency highly dilutive equity raise. So to me, it sounds like they're fairly far along. This is obviously not a great outcome, but I imagine that a deal will be consummated within 6 months, 6 to 9. They'll at least announce the deal, and I don't know what that's going to look like. I know we've mentioned in the past, using the Chalmette facility that ENI and PBF had agreed to a 50-50 JV on, and what did they pay per barrel, and how much of a discount do you attribute? And the other issue with the renewable diesel facility at Vertex is it's only at phase one. So, you have a throughput, I think it's like 8,000 barrel at phase one. It can be up to, I believe, 14,000 barrel per day, which requires some incremental investment. So, you're using the 8,000 barrel comp, 14,000. So, I mean, it's mucky. I know Jeremy Raper had kind of commented earlier in the week on his thinking. I think people are really overly discounting this, but management has failed time and time again. So they've gotten no benefit of the doubt. market sold them off. I mean, it closed today down another 7.5%. So the market cap's at 210 on the equity. Yeah, I'm still long what are now deep out of the money calls, and I'm inclined to think that they get a deal done. But that was kind of the response from IR.
That's a lot for me to just like digest. I'm gonna have to like catch the replay after this.
Yeah, let me. Well, the link was shared in the energy channel a few, I guess 2 days ago, whatever day it was, on the 3rd. So if you look in the Discord, you can find that link and review the communication yourself.
Oh, okay. I think I see it now. Speaking of which, Vertex Energy doesn't have like any exposure like in the California market, right? They don't have any refineries out here.
They export their renewable diesel. They have an offtake agreement to the California market, but that's their exposure, the extent of their exposure.
I mean, like, do you know any other like refineries here besides like ExxonMobil or like the Shell company out here that might be undervalued? Because like the more I look
PBF
at
Energy has multiple refineries on the West Coast, around 300,000 barrels per day throughput. And I think PBF, has also sold off. People hate refiners generally. Could it trade down again into the 30s? Sure. They have a pretty robust buyback program in place, so I would be pretty ecstatic if management's able to repo shares in the 30s. But PBF, it's trading at like a 5-ish PE on a forward basis, and they have no debt. They have, again, I know I've mentioned this multiple times. Like a lot of these companies completely changed their balance sheets, pre-COVID versus present, and they're one of them. That they had debt heading in, they were able to pay all that debt off. They have no net debt. They're trading at an undemanding valuation, but again, nobody likes these assets right now, and that's the challenge for Vertex, is that they are under a time crunch, right? They need to close this JV deal, and gets back to the point of you're going to have less bargaining power if your negotiating partners know you're under a liquidity crunch. So I understand where they're coming from, but the reality is the market for renewable diesel valuations has just been in decline. LCFS credits have declined. Some of the it's a very ugly space that no one really cares about. The M&A levels, and both activity levels and valuation levels for refinery assets, have been pretty depressed of late. So we'll see what they end up getting. But PBF has Martinez and Torrance in both SO and NorCal, and they have about 1 million nationwide of barrel per day capacity. But yeah, about 30% of that's West Coast in California. So PBF is another mid cap refiner. That's one I have a 3.5% PA allocation to PBF.
I'm gonna have to take a deeper look, but yeah, like the only reason why I'm like just talking about this is because what was it? I think I was talking with like another oil head essentially, but funny enough, California in itself is kind of like Japan. We're in a little bit of an island, because of geographics. We can't exactly build a pipeline through the Rockies or whatever. Not to mention seismic issues might be an issue also. But for refineries, though, I mean, we're a pretty big economy, and then I don't
It's
think
not just geography; it's public policy. Just like in the Northeast, it's public policies is more so the reason why you don't have those low cost energy imports going into the California and the New England markets.
Well, yeah, that too. But then building through the Rockies would kind of suck. And then how long of a pipeline would it be from through like the southern deserts? Like, would that be allowed?
It would be
Maybe.
cheaper than
That'd be-
sending a ship around the Cape or through Panama to send the liquid fuels. But again, California does California things.
that is true. I mean, like you wouldn't be seeing like what was it? There's like that one gas station that sells like double or triple the price of the average California price at this one specific gas. I think it was like a Shell or a 76 off of La Brea in Los Angeles here. But yeah, I mean, like gas prices are kind of crazy, and then, or I mean, compared relatively to the rest of the U.S., but it's low at the moment. But in terms of just the need for more energy, like down the line, just I don't know. I'm just like scratching my head right now about this. But
Well, the question there is how much of that energy is in the form of liquid hydrocarbon, gasoline or diesel, as opposed to electricity. And the state of California, of course, would love it if they could snap their fingers and live in utopia land that they seem to wish for. But it's you could definitely argue, and look, there's other issues when you look at the refining piece, because you've got a lot of capacity coming online ex-US this year.
what's
The
that for US?
Nigerian refinery that's coming online, that's nameplate is over 600,000 barrels a day. It's mostly going to make gasoline. I think they're going to start the Dangote at like 400,000 a day. So, I still think the valuations are undemanding, but it doesn't matter what I think. They can always get cheaper.
In terms of like the numbers that you're talking about, in terms of like the valuation, whether it's like cheap or expensive, you're just looking at like it relative to the other sectors, right? Like the general PE ratios. Is that what
I mean, I would, if I were trying to compare refiners to one another, I would try to like understand how much am I paying, per barrel for the enterprise, right? And it's obviously going to be a little varied, right? PBF, the California actually refineries are viewed more as a risk. So could California put some onerous tax on all of the refining profits accrued in the state? Like there's regulatory risks in different regions of the country. There's different competitive dynamics, in different paths. So but at a high level, I would think trying to look and see, what's throughput, for this company, how much am I paying per barrel? PBF is going to look cheap for sure on those bases, but it's worth appreciating why they trade at such a cheap like level is in part because of the exposure to California.
I mean, like, here's the other question. Like, are we still in a freight recession right now?
Yes.
Okay, so what happens if the freight recession ends? And majority of California, I mean, like, we do have a robust, what you call it? Like, I don't know whether if I
We
want to
had
say
this
robust.
conversation. I don't know if you joined after, but Austin and I were kind of going back and forth. I think the hope of the optimists in the room, the bulls on the transport side, is that we get somehow demand rises massively like it did, in 2020, 2021. I'm not sure where that comes from. I mean, yeah, you've got inventory levels that have broadly normalized, but I don't think there's a huge restock needed in 24. So like, yeah, you may no longer be in recession, but that doesn't mean that it's hallelujah, all is well. It's the pain has become lessened.
Are you able to like find that data like locally, like let's just say hypothetically California, like, or like is the data that you're getting like nationwide specifically?
What data are you asking
The,
about?
the freight data that you're looking at to determine whether it's a recession or not, or like the level of freight traffic, I guess.
So if you Google CAS Information Systems, you can find their monthly report. They've been publishing the shipment data that I was kind of pointing at. Because remember, there's the absolute level of shipments, and then there's also the absolute level paid for it. The amounts paid are still very elevated. And The reality, though, is that volumes of actual shipments are at 2019 levels, which 2019 was a freight recession year off the back of very strong 18. And really 17 is when things got going after, I think, what was it, Harvey? There was a slew of hurricanes in summer of 17 that plus TCJ, Tax Cuts Jobs Act, kind of got things humming, and you had a big freight boom, in late 17 into 18. And then what happens after a boom? You have a bust. It is a very boom bust industry. Going back to kind of the competitive dynamics we've talked about, given there's no real barriers to entry, and such as transport.
And then like the freight rates that you just talked about, can you put a link in like the Discord somewhere? Well, I kind of want to take a look at it myself. Is there like a delay in the data? Like it's from like data from like 3 months ago, and
Well, it
the
depends
numbers
what data
for
you're talking about. That CAS report I referred to is going to be from their own billing data. They manage some billions of invoices that they pay. So that's where they are coming up with their data from. FreightWaves has its own data. DAT has its own data. There's a lot of different industry players that have their own data that I would look at all of them, not just one. But it's a pretty, I don't think it's a very out there stance to say that it remains in recession, even though it's broadly expected that that industry is no longer in recession at some point as we get deeper into this year.
No, I mean, like, would it have like the data, like recent data from the holidays? I'm just kind of curious, is what I'm asking.
But what data? Do you want lane specific data? I mean, this stuff is all very regionalized and very individualized for specific transportation lanes. Like you can get aggregate data, nationwide data too. Like, but what are you trying to understand, I guess? And
Oh
FreightWaves would
yeah, like
have some really good lane specific data, but you're probably gonna have to pay them to get that granular. I haven't talked to them in a couple of years on that stuff, but when I was at Ryder, we got a lot of that data, obviously.
well, actually, yeah, like it'd be a combination of stuff. So like if let's say hypothetically we put together like a spreadsheet. Uh, I'm just kind of curious on how California did in general, within the last month or two, and how much money that what they spent versus, and also on top of that, like which routes that are taking. I'm
Right.
just
So
like
you'd
kind of curious.
also, then there's a lot of stuff to consider around. Will you have a mix shift of higher mix of inbound freight from China that decides to go into a SoCal port rather than pay an upcharge to get to the front of the queue now through Panama to get to a Gulf or East Coast port? Like if you're looking at just say SoCal ports, you might not get the full picture. Then if you consider what's going on in Savannah, what's going on on East Coast ports, like I don't know. I'm just trying to understand what data if you want to understand California
Oh, sorry,
only.
sorry, sorry. I guess like I meant to be a little bit more. Yeah, I meant trucking, specifically trucking, California. Last 3 months. Just kind of curious, like where things were going around. Just out of curiosity. So.
Yeah, I guess I'd look for like rejection rates in certain high volume California lanes, like LA to Dallas or Atlanta, or some of the I-10 stuff that takes a lot of the freight volumes. Like what are prices doing there? What are tender rejections doing there? To get a sense for tightness or looseness in that. But I'm pretty sure you're gonna have to pay FreightWaves to get that level of granularity. I offhand don't know where you could get what you're looking for free.
Oh, I don't mind paying. How much is it per, like, is it like a monthly fee, or is it like a one-time fee
No
per
clue.
report? All right. Well, I'll look
I
into it.
haven't haven't had that discussion with them in years.
I'll definitely like maybe DM you later about it. But all right, thanks for that info.
Yeah, like FreightWaves has a really robust paid service called Sonar, but the question is, like, you can go on their website and request a demo if you want to play around, with it. I'm sure they would they would, but I have a sense that the cost is going to be much more than you might be thinking. It's, I think, more business oriented, rather than like just maybe consumer/investor trying to get some data. But let me know what you hear if you dig into it.
Will do.
We're 10 minutes from the top of the hour, so we're going to wrap pretty soon here. Somehow we just always talk about freight, and I don't have anything bad to say about that, but sure. Some people are probably like, dude, no one cares. Let's see.
I'm sure it's a very interesting subject. I just personally don't have any interest in it. But I'm sure everybody else who actually does care about it appreciates your thought, Rod.
Here's what I'd like to know, Paul, is when Coinbase is going to stop trading like a token and start trading like anything resembling gravity mode being on, because that short has not been pleasant.
Yeah, I learned the hard way because I had a few positions last year in some, like, obviously just shit companies, and I learned the hard way earlier in the year of, like, you can't just, if you have any gain in them, and it's very speculative with how the wind blows, just take it. And honestly, like, I had to take a loss on Nvidia. I took a loss on a firm, even though I still think BNPL is one of the biggest bullshit industries out there right now. So I took the loss and moved on. I was like, I'm done. I can't play this game. This game is not working in my favor, even though the underlying companies themselves are just absolute garbage. So power to you for lasting this long. But with Coinbase, I can't do it.
The narratives just don't really make sense to me. Like, why would I guess it doesn't matter. It's just whatever the mob believes.
No, you gotta stop right there. Any rational thinking as to why or why not something does or doesn't happen when you're dealing with these companies, as I'm sure you know by now, there's just no point. It's like wasted energy. It's wasted time. It's wasted energy. It's wasted resources. It's like, when it comes to, especially when it comes to the shorting side of things, I've just learned to focus on the companies where I know I can actually understand what's going on, right? So, like, otherwise, you're like just trying to bet against which way the wind is literally blowing at that time of the day. It doesn't make sense.
Yeah, it's just incredible to watch the sentiment on that, because clearly crypto is just very much a gauge of risk on and off sentiment and liquidity, and like watching how people become so hyper optimistic about it after it's run up 400% is just typical. I still don't know where they're getting any of their cash flows from, but they don't care about that. They're just trying to sell it to some rube for more than they paid.
Yeah, but then you also have to ask the question too. It's like, once FTX fell, it's like, oh, cool, it's just Binance, and then the SEC went after Binance, and then like they're under scrutiny. It's like, at what point is Coinbase going to be on that next hit list?
Yeah, I hope they all end up in jail as they deserve, but we'll see what happens.
Yeah, because CZ's still waiting trial, right?
Honestly, I don't pay enough attention to it. I'm not sure.
Yeah, I don't care enough.
All right. Well, we had a good 2-hour discussion. It's 5 to the top of the hour. I am hungry, and I'm going to wrap this here then. Joe, do you want to take us out?
Yeah, good discussion today. I'll wrap it up. So we did host a Wednesday open mic discussion on a 2024 financial year outlook, which is now available on YouTube. So check that out on the Wook YouTube channel if you haven't seen it before. Otherwise, we host these discussions every Friday at the close on this account at Wook Capital. So tune in here next week for a similar discussion. And with that, I'll wrap it up. So thank you, everyone, for tuning in. Hope to see you again next week.